Everyone dreams of the perfect retirement, but when should you actually retire? I'm going to break down the good and the bad of retiring at 50, 65, or 70, and the surprising financial and lifestyle impacts most people overlook. I'll show you a real retirement plan and how the strategies change at each age so you can confidently plan your own retirement without second guessing your decision. Let's dive in. Retiring at 50 sounds like the ultimate, escaping work early and enjoying decades of freedom. But what does it actually take to make this work? Let's look at Chris and Jennifer, who are 45 today, to see how this decision plays out. And I've simplified their plan for our comparison. Your numbers will undoubtedly look different. Focus on the levers we pull at each age so you can consider your own retirement plan. So Chris and Jennifer earn a combined $230,000 and are maxing out their 401ks. They'll both have Social Security in retirement, and right now they have $1 million in investments and own their home with a low fixed rate mortgage. They initially estimate they'd like $100,000 per year for core expenses. Their big question is retiring at 50 possible compared to 65 or 70. But here's the challenge. Retiring at 50 means giving up 15 critical years of saving and compounding from the standard age 65. It also introduces big financial hurdles like covering healthcare costs and bridging the gap before Social Security starts. To make retiring at 50 work, Chris and Jennifer would need significant adjustments. So here's what we did. They're going to need private health insurance costing $24,000 per year until Medicare kicks in at 65. They're going to need to sustain their portfolio, so they need to save an extra $50,000 annually for the next 5 years. Funding a health savings account provides tax-free benefits for medical costs and could be a good idea. Building up their brokerage account also is key, since 401k withdrawals before 59.5 would trigger penalties. Now, their retirement spending would need to drop from $100,000 to $50,000 annually after taxes, half of what they planned. Now, this could improve over time depending on how their investments perform, but it's a tough adjustment up front. Often those that retire early are willing to live on less. So while $1 million sounds like a lot, and it is, it needs to last 40 plus years of retirement while accounting for inflation and market volatility and rising healthcare costs. So can Chris and Jennifer make retiring at 50 work? Well, let's see what happens when we make these adjustments. So what we're going to do is we'll go ahead and factor in the adjustments, the healthcare costs, the increased savings, reduced living expenses, and a strategy for claiming Social Security, at least with one of them at age 62 while the other defers for a higher benefit. So here's their projected portfolio value, and each bar represents a year of their life, and the bar size is their nest egg. Now, under these adjustments, their portfolio could sustain them until age 95. But this plan isn't for the faint of heart. There's little margin for error, especially over a long retirement. Now, and what we can also see here is that the probability of success due to that time frame, I'm using a Monte Carlo simulation, is almost 50%. But keep in mind, even a dollar short is considered a failure, and they would need to adjust as needed. But what else should they consider? When they do retire, it's critical to maximize their income while minimizing risk and taxes. Transitioning from savers to income takers is a delicate process. Having an income withdrawal strategy based on data-driven research is key. I'll actually link to a video where I break down 4 time-tested withdrawal methods that you can choose from. For Chris and Jennifer, taxes in their early years of retirement would likely be much lower. This creates what we call a tax valley, an ideal time to convert some of their pre-tax 401k money into Roth IRAs. This builds tax-free income for later in life. So overall, retiring at 50 would require some financial sacrifice for Chris and Jennifer, but it could be fantastic, exciting, and full of adventure. But let's see how it's different if they retire at 65. Retiring at 65 has long been seen as the default age for a reason. Medicare kicks in, Social Security is available, and you've had time to build a solid retirement nest egg. For Chris and Jennifer, retiring at 65 would give them the financial flexibility to not just retire, but enjoy the lifestyle they've worked hard for. Let's take a closer look at what this would mean for them. So by age 65, Chris and Jennifer will have been aggressively saving for 20 more years, allowing their investment portfolio to grow thanks to compounding returns and continued contributions. So due to this flexibility, we've added a $15,000 annual travel budget to their projection for the first 15 years of retirement, so they can enjoy seeing the world, visiting family, or even pursuing other hobbies while they have the energy and the interest to do so. Also, their Social Security benefits are available. Even deferring until their full retirement age of 67 leaves very little gap. And Social Security adds a stable income stream to their plan. And Medicare lining up when they retire makes healthcare far more affordable and predictable compared to retiring earlier. So retiring at 65 not only provides enough financial security, but allows Chris and Jennifer to enjoy life while they're still active and healthy. So let's look at the adjustments we've made. We add in the $15,000 annual travel budget for 15 years. And here we don't need to include private health insurance because Medicare does kick in. And overall, they could have more flexibility with their spending. And their probability of success is strong at 81%, we see. And while this may seem like a B- grade, in retirement planning, it's very solid and gives them a position of flexibility. If their investments perform well, they could even afford to spend more by managing their spending with guardrails to guide them when to take a raise or when to tighten the belt in a downturn. But what else should Chris and Jennifer be thinking about? At their current ages, where they save during their working years is critical for setting themselves up for flexibility with retirement income. For example, redirecting some pre-tax 401k contributions now into Roth can provide tax-free income in retirement. Adding to their brokerage account creates more liquidity and flexibility, especially before Social Security kicks in. And between retirement and the start of required minimum distributions or RMDs in their 70s, they could also take advantage of that tax valley to convert some of their pre-tax 401k money into a Roth IRA, minimizing future taxable income. And by claiming Social Security at their full retirement age of 67, they lock in that reliable income stream, and perhaps even deferring until 70 for one of them could increase benefits further and leave the higher benefit to the survivor. For many, 65 is that sweet spot for retirement because it balances the financial security, health, and lifestyle goals. Retiring at 70 often gets a bad rap, but it's not all about waiting and working longer. For many retirees I work with, retiring later doesn't just mean better financial preparation. Often they love their work and position themselves with flexibility to enjoy traveling and hobbies while still working. Let's see how a late retirement would look for Chris and Jennifer. So by age 70, we can estimate that Chris and Jennifer's investment portfolio has grown substantially thanks to 25 more years of compounding and disciplined savings. With their wealth at its peak and a shorter retirement horizon, they can afford to spend more and give more. So we're going to go ahead and add in a $20,000 annual travel budget from age 70 to 80. Letting them enjoy the experiences and this family time. Now, the downside is this window may be short if they don't integrate travel into their working years. We will also add $20,000 per year to charitable causes they care about and $36,000 per year in gifts to their family, allowing them to see the impact of their giving firsthand. So at this age, they've maximized their Social Security benefits by deferring until 70, so creating a substantial and stable income stream, especially for the surviving spouse who will keep the higher of the two benefits. Now, if they choose to start Social Security early, they could do so at their full retirement age, even while they're working without incurring penalties as long as they're at that full retirement age. So let's take a look at their cash flow projection based on the adjustments to their plan. So we'll go ahead and add in the $20,000 travel budget for 10 years, the $20,000 for charitable giving, and the $36,000 for gifts to the family. And even with these added expenses, the portfolio remains strong, and it's projected to last well into their 90s and even perhaps through the 90s. Their Monte Carlo simulation shows an 80% probability of success even after factoring in these much higher spending and gifting allotments. This scenario gives Chris and Jennifer the confidence to enjoy their wealth, support their loved ones, and give back, having confidence that their financial future is secure. But what else should they be considering? I mean, being in a stronger financial position opens up unique opportunities. Their increased wealth allows them to be intentional about how they leave assets to family or charities. By retiring later, their working salaries do push them closer to that RMD age. So with larger account balances, RMDs can significantly increase their taxable income. A shorter tax planning window makes it even more important to build Roth and brokerage accounts through contributions. And then at this age, healthcare and long-term care costs become more likely. Allocating a portion of their wealth to these expenses can help avoid financial strain from healthcare expenses. Retiring at 70 would give Chris and Jennifer the financial freedom to spend more, give generously, and leave a meaningful legacy, while the downside is having fewer years to possibly enjoy their retirement. Their strong financial foundation allows them to make the most of the years they do have. For you, what's more important? More time to save or more years to enjoy it? If you love your work and can gain flexibility in your later working years, don't let the bad rap of retiring later discourage you. Now, if you're wondering how to tie it all together, spending in retirement, the investment plan, giving to family, the next video you have to watch you'll find up here. I go through the financial plan of Brian and Lisa and what life actually looks like with $6 million. And if you'd like to talk to me and my team about how we may be able to help with your retirement plan, just click on the link in the description to schedule a brief call. Thanks for watching.